All right, welcome, folks, to the monthly market update provided by ClearVista Financial. We call this ClearVista Financial Perspectives. We are glad that you have taken a few moments today to join us or listen to our reproduction of this broadcast, which is available on our YouTube site at youtube.com/spinlifewell. We have lots of different videos there for you. So today we're going to do as we do always by discussing the performance of our indexes for the month of September. September ended up being a good month, out of the ordinary, actually. And we'll talk about the economy. Still a lot of mixed data about the economy. So we're going to get into these a little bit. As always, you can text your questions to 254-282-0495. You can send those at any time, day or night. We may not answer them until the next day, but you can send those anytime, 254-282-0495, or you can email us at info@clearvistafinancial.com. Well, let's just jump into the market recap. As I said, September was a great month for most indices. And we'll get into these a little bit. I'll show you a few charts and things. But remember, on the last broadcast for the month of August, early September, we said that September through the end of October is typically a fairly volatile time. And historically, the S&P 500 has gone down during that time most years. Well, this year was the exception. And there's a number of reasons why that may have taken place. S&P 500 was up 3.53%. NASDAQ was up 5.61%. The Russell 2000 cooled off a little bit. Remember, August was a spectacular month for small caps. The small cap index only went up about 2.89% in the month of September. Long-term treasuries stabilized, didn't go down much, didn't go up much. But we think we see a bottoming pattern there, especially since interest rates are starting to go down. And our moderate index, which is for a lot of retirees might be what you're invested in, you can see there that was up about 2%. So let's jump into a couple of charts. The S&P 500, this is going back this year. You see the dips there with April, and we recovered from that. We have been setting all-time highs. Now, after the last few days of September, there was a little bit of a market sell-off. And so we're not at all-time highs right now, but we are very close. And a lot of that will depend on more economic data as it comes out. The Federal Reserve meeting later this month, a number of different things. So that's important to keep an eye on, but markets seem to be doing or reacting strongly to the data that they're presented. Okay, this is the NASDAQ. That blue line there was the all-time high. We broke out of that in the summer in June, and we have maintained those levels above at near all-time highs. Russell 2000 just can't seem to break out of that resistance there. The blue line there indicating the resistance going all the way back to 2021. And we'll see in October, if the Russell 2000 is able to break out and go to new highs. Right now, not so much. You can definitely see there by that line that's a strong form of resistance. And for small caps, a lot of that is fueled by interest rate cuts and lower interest rate. We had an interest rate cut in September. We'll talk about that in a moment, but we still haven't seen enough data there for small caps to take off. Long-term treasuries, we know the sad picture, the end of a 40-year bull market in bonds. It's still struggling. We are seeing that to stabilize. You see a consolidating pattern here at the bottom for the last 12 months or so. But still, that's going to depend on the interest rate futures and then also to the future of the economy. Moderate index did finally break out to all-time highs in August, but you can see that goes back to 2021 as well. And I'm really coming out of COVID. We still haven't We recovered, but we still are staying above that level breakout. So that's a positive sign, indicating that stocks really are pulling the weight there. Bonds, not so much, but stocks are pulling their weight now. And I'll leave this disclosure up for us. There will be a quiz at the end of the day's program. All right, volatility. We are still in that seasonally volatile time for the S&P 500, okay? Now, that does decline in the last quarter of the year. So if history is any indication of what's going on, then this is going to be a less volatile time of the year. We've got 2 Federal Reserve meetings during this time. We've got the expiration of some of the tariff deadlines. So a lot of things can happen in this period, but we typically historically see less volatility in the fourth quarter of the year. All right, so let's jump in and talk about what's going on in the economy. Reminder, folks, you can text us 254-282-0495, 254-282-0495, or you can email us at info@ClearVista Financial. All right, so let's take a look at the Treasury yield curve. Remember, for about 3 years now, this yield curve was inverted, where the shorter end of the yield curve was higher than the longer end of the yield curve. That has reversed. Now, typically, historically, when you have that reversal of the yield curve, of an inverted yield curve like it has been, the economy tends to go into a recession. We haven't seen it this time. So that doesn't mean we can't have one. Does that mean the risk of a recession is off? No. Just means we have not seen it in the typical fashion that we have historically. But it's something to watch. We're still seeing short-term yields fairly high, and long-term yields a little bit higher, but not near where they were a year or two ago. Federal funds update. This is the forecast. There was a 1/4 point interest rate cut by the Federal Reserve on September 17th. Markets had really already baked that into their expectations. I think markets were a little disappointed there wasn't a 0.5 percentage point rate cut. All that will begin to trickle through the banking and lending system. We've already seen, fixed annuities drop by 1/4 point or more. So you're going to see that trickle down. And then the Fed is meeting at the end of the month. So they may cut interest rates again. We expect at least one more interest rate cut by the end of the year. Of course, we said that last year too. But this is the Federal Reserve. Of all the Federal Reserve presidents around the country, this is where they expect interest rates to be in the future. And you can kind of see there's a few here, 1 or 2, that expect that interest rates will be below 3. Right now, they're in the 4 to 4.25% range. Some expect them to be around 4. And then, like, going on next year, we see almost everybody's saying that they're going to be below 4%. And then that begins to shift downward as we go through time. A lot of people, the thing is, these dot plots are really more just about the expectation that the Federal Reserve presidents have, not actually what will happen. But it's always interesting to see what they themselves are kind of predicting. So perhaps, you might have been disappointed that the Fed didn't lower interest rates more, but doesn't mean that the Fed has not been boosting the economy in other ways. I wanted to show you some information on reverse repos. Now, reverse repos are like a hidden form of quantitative easing, which we had a lot of in COVID. It's where the Fed will release liquidity into the markets. That kind of helped drive the rally since we've had since late 2022. At their peak during COVID, there was probably $2.5 trillion on the Fed balance sheet, or how much they were doing then, and how much they were pumping in liquidity into the economy. Now that's gone down to about 25 billion. Now what that means is that tailwind that you're seeing there is not the same as it was, last year. So that easy liquidity is going to run its course. So for stocks to push higher, they need more gas, they need more fuel. One possibility is that the Fed might be reintroducing the traditional repo agreements, which those directly lend liquidity to banks so they can loan more money, et cetera. But if the Fed doesn't step in, the markets are going to need to show that they can sustain themselves without that artificial liquidity. And that's something we haven't seen in a long time. We don't know if the markets can handle that. So what this could mean is that during this period could be more volatility in the markets as investors test whether or not the bull market can continue on its own. It's amazing to learn all the different things of how the Fed, the Treasury, all these different things are, and even individual companies themselves are influencing the direction of the markets. So let's talk a little bit about economic growth, money supply, some recent revisions in the economy with employment, signaling that the economy was really weaker than we officially thought. Most of the growth in jobs came from the government and healthcare jobs, while employment in the private sector actually shrank during the month of August, and they revised some other months too. So we're going to get into that just a little bit more in detail in a moment. But you've heard me on here several times talk about the money supply, or M2. Now, that money supply dropped pretty rapidly in 2022, 2023, and that we were concerned about that the economy may be contracting too quickly. But that was just really kind of a hidden slowdown in the economy, if you will. So immigration could be affecting the growth of the economy. Deficit spending during that time also temporarily propped up things, but all those are slowing. The government's not pouring money into the economy like it was in 21, 22, 23. So, we're expecting that the Fed is going to cut rates again at least once this year. That will help boost liquidity in the markets, but it's more like putting out a fire rather than creating new growth. It just keeps the economy from slowing as fast. So looking ahead, a smaller government role may set the stage for stronger private sector growth, but in the short run, we should expect some economic headwinds, okay? Let's look at GDP. This is one of the contrarian views. Employment slowing, but gross domestic product is stronger. The economy is proving more resilient than we expected. So it's kind of hard to read all these different variables to determine what's going on. But they revised the second quarter GDP growth upwards, and that's a positive there. The core GDP, which strips out all the volatile categories, came in at a healthy 2.9% annualized. And that's showing that the underlying demand is still pretty solid. Now, we haven't gotten GDP numbers yet for the month of September. Since the government shut down a couple of days ago, that may be delayed. We're also looking at employment, and that might be delayed as well. So we think inflation is contained. The CPI did tick up just a little bit. The Consumer Price Index did tick up a little bit in September and August, but we don't think there wasn't any big surprises there. So employment, this was the big news, and people got fired. President Trump didn't really like the results. Predicting employment or even estimating payrolls, it is not an exact science. ADP, the employer payroll services company, they do predictions. Then the Bureau of Labor Statistics does predictions. And that's all they are. They're basing their predictions and numbers off surveys. And I don't know about you, but I'm not a big survey taker anymore like I used to. And so I'll get around to doing the survey when I've got time, and I may not do it at all, even though you're requested to do those things. So companies are the same way. They don't necessarily have the time to report these things. So that's why they go back, and it is common to go back even a year, and they do that in March, do a April to March time frame. It's common to go back and revise payrolls up or down. In this case, it was down. We were expecting 77,000 new jobs. It was actually only 22,000. The prior months were revised down by 21,000. So the net gain was only about 1,000 jobs. So that seems kind of drastic on an economy as big as the U.S. Private payrolls, 38,000 new jobs, but the majority of them were in healthcare. There were still continuing losses in manufacturing. So this whole process of, we've talked before about how efficient American manufacturing is. Payroll, those jobs continue to drop. And unemployment ticked up just a little bit for the month, and that was at 4.3, still within normal ranges that we see there. But we may see, increased employment numbers decline as the economy cools off a little bit. So if you take all these things into context, it does show a weakening, but still slowly growing economy. And that's going to give the Fed, I think, more reasons to cut here at the end of October when they meet. Okay. All right. Producer price index. This is another indication of inflation. They unexpectedly declined in August, pointing to some inflation pressures being eased. On an annual basis, the prices are still rising modestly, with goods up just over 2%, services around 3%. So these things are all okay. This also supports the notion that inflation is on a downward trend, despite some of those earlier concerns about tariffs and things. So, we did see the Federal Reserve cut rates, and I think they'll continue to do that. The only exception is that the language that was coming out of the presser that Chairman Jerome Powell did was that we're seeing modest improvements on inflation and things. So they use all their terms to temper their words and make sure that no one overreacts to things. So now the CPI, that's the consumer side of inflation. That was up a little bit, 0.4%, as I said. So once again, the hot part of that is the housing cost, and airline fares were the biggest contributors. Workers' wages are still growing, but they're being tempered modestly. And, we expect that to continue in that way for some time to come. A lot of people are arguing over whether or not the Fed should adjust their rules. They have a 2% target rate, but is it something that should be 2? Should it be 3? Well, that will remain to be seen. For now, their target rate is still 2%. Let's talk about retail sales. Retail sales rose more than expected in August, showing the consumers are still spending despite the job market slowing down. Sales gains were broad, led by online shopping, automobiles, restaurants, and clothing, and back-to-school basics and stuff like that. So core sales, which feed directly into GDP, rose. They're on track for the fastest quarterly pace since 2023. So that's good. So consumers still remain strong, but we have to make sure that we're continuing on that track. We'll continue to watch that. All right, new and existing home sales. Now this is kind of split. All right, existing home sales struggle. All right, existing home sales fell by, I think, was it 8% for existing home sales. New home sales really exploded, up over 20% in August. So once again, a little bit of a dynamic there. It could be, interest rates for mortgages dropped just a little bit, and I think there might have been some, perceived results of that going on there. But we'll have to watch the Fed rate cuts underway. Affordability is improving. We're seeing in the data, the median price is dropping a little bit, but that could stimulate a modest recovery in the housing market. Will remain to be seen. Housing starts were down in August. That's a seasonal type thing, we think. And so we're not too concerned about that, especially when you have new home sales and what's going on there. Okay, let's talk about the impact. What does this all mean? You want to make sure that you're talking to your advisor and reviewing your financial plan. With the One Big Beautiful Bill, that would be a lot of changes coming in the tax code. We've been doing webinars on that and some events. If you have not talked to your advisor about that, you'll want to make sure that you do, so that you can make sure you're taking steps to make changes to your retirement plan so that you can get those by the end of the year and certainly next year. And the things that the government or Congress has labeled as permanent changes, as I told a group of clients earlier this week, really look at them as if they're written in pencil, okay? Permanent only means permanent if the next Congress doesn't do away or undo everything that was done in this Congress. So keep that in mind. If you're thinking about doing Roth conversions, this year might be the year, next year might be the year, and who knows after that? Well, all we know right now is what's in place right now. And the OBA, the One Big Beautiful Bill Act, has a lot of changes that are impacting a number of families, especially seniors, with that $6,000 per person deduction for being over 65. It has a cap on the income, but it is not a cliff. It's a gradual decline once you reach those levels. So you need to take a look at your 401k. A lot of folks, 401ks are still struggling because they're not getting advice. They've kept them invested in whatever's been there since the plan was set up. You need to take a look at that. That, for many people, that is your largest retirement asset, your largest asset sometimes beyond your home. And you need to make sure you're staying on top of those things. So, as always, check your statements. It's been a good year so far. Talk to a professional. Make sure you're educating yourself. And please, 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 folks, with the exception of our videos, don't watch the YouTubers, especially if they're 19 and they are telling you about how to interpret the tax code. We're seeing this stuff all the time. A lot of it's artificial intelligence generated, and a lot of it is absolutely wrong, incorrect. So make sure you're talking to a financial professional, a real person, not a robot or a chatbot or anything, and make sure that you're educating yourself about those things. So I'm looking to see if there's any questions. I did not see any on the text line, but as always, we will keep those going, and we'll look at those questions throughout. But that, folks, you can always contact us at our office. You can also send us an email, or if you just want an appointment, you want a phone call or a consultation, we'd be glad to do that. You can look at my Calendly there, calendly.com/Mark Trice. And our next market update is November the 6th. Man, we're getting into the Thanksgiving and Christmas season already. So I hope you're having a great year so far. Join us next time. As I said, this recording will be up on YouTube soon. Thanks so much, and thanks for joining ClearVista Financial Perspectives.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.